why the products that you guys were focused on. So as you look at the marketplace prior to kind of leaving and then building your own firm, there's always this like, I've got some edge and I've got some experience, and I think we can do something that's better than everybody else by going into this path. So kind of give us, and tying with Bison and Liquid Strategies, what is that edge and that perspective that you guys brought to the table to say, hey, we could probably do it much better than the guys over here, even though they've got thousands of employees, billions and hundreds of billions in assets, and now trillions in assets in a lot of these firms. That also gives you the edge and has a unique story, because that's one of the main reasons why we've partnered with you, because there's a lot of firms out there, there's a lot of wealth managers out there, and there's a lot of asset managers and a lot of firms and funds out there. Kind of walk us through what you guys saw as you were getting going that was your edge and was your differentiator.
So maybe I'll just do the frame and then I'll let him get into the details. So first of all, the frame was honestly, we began, as I mentioned, Bison is a wealth firm. And the idea was this was a vertical integration play. And the funny story is, on the back of my porch one day, I saw an Amazon truck delivering its 39th delivery that morning. And I thought, man, that Bezos, he's really got it. He's got all the Amazon big data stuff, and then he sells everything. And now he delivers everything to everyone. So he has really made, vertical integrations. He's perfected it, you could argue. And so I thought, well, we're not going to be that. But if we did have a wealth business that desires to have good products and desires to have differentiated products, and a thing that a lot of investors crave and advisors crave is being closer to the portfolio management team that manages the money. They want to be close to that. And so by creating an organization where they're closely linked together, I saw as very symbiotic. And so from my end of things, we launched the wealth firm. As we got into the wealth firm, we started understanding. One of our colleagues who used to work for the military, in fact, he flew Marine One, really interesting fellow. Sometime maybe have him up here. You've met Greg, and so he landed on the White House lawn with presidents. How cool is that? So anyway, he would tell you that's interesting. Defense contractors, when they build a product for the military, they don't sort of go build a product and go to the military and say, "Do you want this?" It's quite the other way around. They go to the military and they spec out. It's like, what would you like? What would make your troops more battle ready? What would give you a competitive advantage versus the marketplace? And what they would tell you is that only after they found out what was in need did they actually try and build things. And that's really the essence of what the stuff that Mark, as a portfolio manager, and his team do. We had wealth teams that were using buffered ETFs and structured notes and some other structures that gave clients a more defined outcome product, rather than just being in long equities or a long short strategy or a bonds. And so we had a need. So back to the military example, we sort of spec'd it out from the clients. What would they like? What's the kind of thing that would give them a solution that would be attractive? And then we put our smart people onto the equation to figure out how to go about doing it. So that's teed up for you, Mark.
Perfect. And so at Liquid Strategies on the asset management side, I mean, everything that we do is it's designed not to be generic, right? It's designed to be something that is disruptive and different in the marketplace and differentiated as opposed to SPY, the S&P 500, right? So the strategies that we developed over time and believe and have run over a long period of time, going back to 2014, start with a put spread overlay strategy, which is just a way to generate extra income on top of whatever underlying investment that you have. So if you have the S&P 500 is the simplest example, SPY or VU, the Vanguard ETF, that most people know of because they're readily available and accessible. We put that put spread overlay strategy on top of it, and it generates about a percent or two of extra return on top of the S&P 500. So who doesn't want S&P 500 plus an extra 1 or 2% on top of it over a long period of time? That adds up, right? And so that's the basic strategy that we have, but we've developed a lot of other strategies also within our complex that hedge equity downside, that provide extra income, and can provide a smoother ride also than just the equity market itself. Then comes the development of the interval funds and the inception of our relationship with Hive, where and where Brad talked about defined outcome strategies. These are strategies that deliver more consistent, steady results to investors. And everybody's familiar with different private credit strategies. Well, and diversification. Well, we took the concept of private credit to a whole new and diversification to a whole new level in the development of Niagara Income Opportunities Fund. The ticker symbol for Niagara is NAGRX. NAGRX. And so that is a multi strategy alternative credit, alternative lending portfolio. So we seek out a lot of different managers like Hive. Hive itself is very diversified by the number of consumer loans that it has. But when we blend 20, 30, or 40 different investments like a Hive, we have a super diversified alternative credit, alternative lending, multi-strategy portfolio that's generating 10 to 11% consistent IRR that's diversified across a lot. So we've democratized um, uh, private credit investing by making it accessible to smaller, non-accredited investors that can invest in this portfolio, have daily liquidity to get in or daily ability to get into the strategy, and quarterly they can get their money out instead of investing directly into one private credit strategy, even Hive, and your money's tied up for 3 years before you have access to it. So customers can get out on a quarterly basis. So, and then with that strategy, that super diversified, generates consistent, steady returns and steady results. Um, we took the development of structured return strategy, and we took that to a whole new level. We looked at the market of what are called buffered ETFs, structured notes, those types of products and strategies that are in the market today. Um, and essentially, what these strategies do is they take the income from the underlying fixed investment, and they buy upside participation in the S&P 500. And so, but with low levels of income, you get low levels of upside participation. So what we did is we took a whole new approach to this market, and we took the returns of our alternative lending portfolio, multi-strategy portfolio, and which are much higher, and we are able to buy much higher upside participation in the S&P 500. So one of the problems or issues of your traditional structured notes or buffered ETFs is very low returns, low upside. We give investors the chance to participate on a quarterly basis in 5% of the upside in the S&P 500. So if the S&P is up 5% a quarter for 4 quarters in a row, we're going to give them 20% for that year. If the S&P is up 10% for 4 quarters in a row, we're going to give them 20%. But if the S&P 500 is down 5% 5 quarters in a row, the underlying private credit portfolio serves as the basis or the foundation of that strategy, and they're going to get around a 0% return for the year. So it's a very different, unique product that offers a defined outcome for investors that fits perfectly, because who doesn't enjoy a smoother ride, whether you're investing in a fixed income security or the equity market?